There's a lot of noise out there right now when it comes to life insurance in 2025. Most of what you're hearing is outdated, incomplete, flat out wrong. I'm here to give it to you straight like I always do. No fluff, no gimmicks, just real truths that I've seen play out over and over again this year. Let's break it down exactly what's changed, what matters most, and how to make life insurance work for you, like as if you're in the ocean and you're going with the current versus going against the current. Let's get into it, folks. A permanent life insurance policy, which is not one size fits all. It's broken up into two categories. We have whole life and we have an IUL, Index Universal Life, which serve different purposes. And it's important for you, whether you're going to become your own bank or not, to understand the difference. Now, whole life is where the company takes on all the risk, guarantees, and cost of insurance that you can rely on to stay consistent and reduce over time. So what does that mean? You could actually plan not just in the first 5 or 10 years, but you could take a look 30, 40 years later from a death benefit perspective on how that could serve you well, knowing you're going to reduce other assets and the death benefit is going to replace it. We call that an eternal rate of return. With that, IULs, they're still great, but has shared the risk and are introducing market performance into the mix. And one thing you can guarantee is the cost of insurance is going to increase as you get older and can cause massive challenges over the life of the contract. So what do I mean there? You get a death benefit, right? Now you're 30, 40 years later and you have rental properties or other things that you're borrowing the money for, but the cost of insurance is increasing each year. It becomes dangerous later on in life. So the best policy, we believe, is the one that's built around your goals, your objectives, not just an agent's commission. And that's why I said at the top, it's important that you understand how to structure these policies, whether it's an IUL, whether it's a whole life, and what does it look like in that accelerated early cash accumulation or cash value up front, and then what does it look like later on when you want to take distributions off the policy and serve that eternal rate of return, which allows the spend and replace mindset. So remember, I got $1 million in an after-tax brokerage account. They're going to tell me to play by the 4% rule. That 4% is taxed. But if you do, which is just interest, but if you do principal and interest because you know that you could spend that down and have the insurance replace it, it becomes a whole nother rate of return in your world. So let's get into term insurance, which could be a trap if you're not careful. It's cheap for a reason. It usually expires before you actually need it. In fact, 95, if not greater percent of the time, these policies expire worthless, meaning the insured passes away before the death benefit could be paid. So I want you to think about it. What good is a life insurance policy if it's not active when you need it the most? The real cost comes later when you try to convert it and or replace it, and that's if you even can. So remember, when you buy insurance up front, it's important to understand whether it's whole life, IUL, or term. Can you warehouse the term? Can you put it inside the policy? Are you really clear on what your cash flow analysis is? Do you understand how over time you can convert it in a certain period of time without doing another medical? And this is important for you to understand this because it'll help you make a decision today when you think 10, 20, 30 years in the future. So there was a time I had a client that had a 20-year term policy, and he started before I met him. And as we got close to buying more insurance, his medical history changed. So when he went back in at 55, because he bought it at 35 and wanted to buy more insurance, medically speaking, he no longer was able to qualify. And now he couldn't even convert the term because it was already too late. The conversion period was over. And the cost of insurance to keep that term after the 20th year went from $1,000 a year for 20 years. And now year 21, it was $5,000. Now year 22 was $10,000. Now year 23, it was like $30,000. And that's what happens after the term is up. In order to keep the policy, you have to basically prepay the death benefit on a yearly basis, broken up over the next 20 years, and it becomes very, very invasive in your money, and you have to cancel the policy. And that's what the insurance company relies on when you buy term insurance. You know, it's funny, from time to time I hear a lot of people talk about how life insurance is a scam, and when you read it on the internet, and if you look at how whole life is presented in year one, if somebody put out $24,000 in a premium and their cash value is $1,000, I can understand why the person that purchased the policy who may not have been informed over that would actually think it is a scam. But let me share a thought with you right now. If the cash value dollar for dollar can be used for alternative investments while it's inside the policy growing tax deferred, that's a good thing. So cash value, in our opinion, based on how we structure it, is never a scam. The loaning power is usually 90 to 95% on every single dollar. The money grows tax-free, comes back tax-free up to basis, and to maintain that tax-free status, you would borrow from beyond. So let me break this down. If you look at what I just said, where if somebody puts, 12, 24,000 a year and they have access to maybe 5 or 10% of cash value in the first year, it's not as fun versus if someone puts 12 or 24,000 a year and they have access to over 70 or 80% of that cash value in the first year. That becomes a much better cash value life insurance play. You could finance cars, you could start other businesses, you could finance your own debt in other areas, and most importantly, if you wanted to really be able to play the real estate game, it becomes a perfect complement as down payments on real estate where you can get multiple uses of each and every dollar. One of the things that we always say is at the end of the video, don't forget to go ahead below, click the link, and book a time to meet with one of our experts. It's a free call. They'll take you through the process, but it's important that you understand that these aren't just like cookie cutter approaches. It takes time, effort to really understand who you are, where you want to go, where you are now. And if we create a financial map, we want to see today and where you want to go and to get there the most efficient manner possible. We don't want to go on back roads where it's dirty, stop signs, and potholes. We want to be on the highway where you're in the lane and there's no traffic. The wealthy, and they should be the people that we look at, they don't ignore this. They build legacies with it. They use this as a tool to help accelerate their growth, protect their wealth long term, and understand the importance of, let's call it the waterfall method, where it goes from generation to generation properly with trust planning, avoiding taxes. The clues are out there, folks. You just got to pay attention no matter how old you are. You don't have to have Rockefeller money to follow the Rockefeller path. So let's talk a little bit about Dave Ramsey, where he talks about all debt as being bad and buy term and invest the difference. I want to play with both of them. Now, any entrepreneur that's watching this video knows unequivocally that not all debt is bad. Yes, credit card debt is bad. I get it. But if you're going to go buy a piece of real estate, there is good debt in there. If you need a student loan, we could talk through that. If you want a car loan and you're getting debt that's above your means, well, yeah, that's not good either. I understand that. But if you use debt the right way, because that's what the bank does when they loan it out over and over again, they make 40 cents on every dollar. It's important to understand that debt utilized with intelligent and the right team around you can create millions and millions of dollars. And that ties into term and invest the difference. Now, I'm going to say it this way. If there's a person from 25 to 65 that had term insurance for 30 years and they every single year invested the difference in qualified and non-qualified accounts, both pre and post-tax accounts, and they followed the S&P the whole time, and even when they had to pay taxes and fees, they took it out of another bucket, that difference at 65 would be outstanding. I'm not going to argue that, but the discipline of term and invest the difference, I'm not sure if anyone really does it, especially in those 5-6 year gaps where they could be struggling financially and the markets don't perform either. So I'm not saying don't do it. I'm not saying don't do the Dave Ramsey way, but what I am saying, Venn diagram, right? Where in this financial mosaic can you do term and invest the difference, especially if the term is inside your whole life? And what does the difference look like? What does the savings look like? What does the flexibility look like? And I think when people talk in, let's call it nursery rhymes, term and invest the difference, that created so much money for the person at Primerica that actually created it. But I'm not sure if the households benefited, the 5 million people that actually bought term insurance. I'd like to know how many of those policies actually expired worthless and put families into debt when one of the breadwinners passed away or shuffled off this mortal coil after the term ran out. So my whole thing is to keep it real simple, understanding what is your cash flow, who are your investment professionals, are they all on the same page, and how can you get the right information to make the right decision instead of buying a bunch of different products from a bunch of different people based on a bunch of different opinions and not knowing how these things work together. Now, let's get into the size of a policy. Sometimes folks get real scared if you bring in a big death benefit, but remember, if you're doing term and whole life, that death benefit's going to be bigger. But let me just talk a little bit about our undersized. Let's say $250,000 for some folks might sound like a lot until, let's figure it out right now, you factor in, most importantly, inflation, debt, what kind of debt, college debt, and lost income and lost opportunity cost on all that. So let's say it this way. You're married and you're making $200,000 a year. Your wife, if she's a stay-at-home, or your husband, if he's a stay-at-home that's going to raise the kids, needs at least 10 times that income to help not financially lose any traction with the kids based on you passing away. And as we work through this, remember, if your policy doesn't match your future expenses, your family could still be left exposed. And here's the truth. Life insurance is a long-term strategy, and you want to think of today. You want to think of your future value as well. What would you bring into your household for the next 10, 20, 30 years? And let's go with that example of $250,000 in death benefit. It may sound like a lot. And as I mentioned before, you want at least 10 or 20 times income. But let's use funeral math as an example to show you how fast the $250,000 can disappear. Life insurance just isn't about death. Properly designed policies can be used while you're living to invest, expand your business, by the way, or access liquidity. Now, it's important with retirement strategies. You don't want to just rely on 401ks or IRAs where you miss the flexibility from a tax perspective on the distribution side of the insurance. And I would argue it's dangerous not to have that in place because some of your investments, if they are just specifically designed to the stock market, you have volatility, taxes, and fees. But if you have the perfect complement of whole life on the distribution side, you could actually have a buffer against that volatility from a distribution perspective. And don't forget about the importance of reviewing your policies even now. It's important to get educated on those policies. What do I mean by that? You may not even know what kind of policy. You may have a policy that's already designed that allows you to jump in and add extra money to it or not. And that's one of the things we can show you how to do. What I can tell you about entrepreneurs, they are constantly using their money in life insurance to buy other businesses, finance their own debt, and or rental real estate or any other kind of income producing asset while the money inside the policy is growing uninterrupted. It's important you really understand all these differences, and we're here to share that with you. All right, folks, the truth is simple. Life insurance isn't just a safety net. It's a financial tool. And like any other tool out there, it works if you work it and know how to use it properly. If you're ready to take full control, book a free consultation with the Epic team, and let's build something tailored, strategic, that's special for you and future-proof. And please, don't forget to subscribe, like, and share this with someone who still thinks insurance is just a monthly bill.